Hi, I'm Dean, an investment specialist in CGSI. Welcome back to our margin financing series. Last time, we explored how margin financing can unlock exciting possibilities, like earning positive yields from dividend stocks, minimizing currency conversion losses, and leveraging your existing shares as collateral to boost your returns. If you missed that episode, make sure to give it a watch. Today, we're kicking things up a notch by introducing a smarter, more flexible way to borrow: grade-based margin financing. Let's jump right in. Let's talk about grade-based margin financing, or GBMF, a smarter way to borrow. GBMF uses a tiered interest rate system that rewards you for holding high-quality securities in your margin portfolio. The higher the grade of your collateral, such as major global index component securities, the lower the interest rate you'll pay on your borrowed funds. This means you can save on your financing costs while maximizing your investment potential. It's a win-win for savvy investors. Securities in your margin portfolio are graded according to their quality and liquidity. Here's how it usually breaks down. Grade A securities are the cream of the crop. High-quality stocks with strong fundamentals, large market caps, excellent liquidity, and with good track record. These are typically valued at 100% of their market price. Grade B securities fall into the mid-tier category. They have moderate liquidity and carry slightly more risk, so they're usually valued at 70% of their market price. Grade C and D securities are considered higher risk and carry more volatile market movement, making them less favorable for margin financing. Understanding these grades help you to make smarter decisions about which securities to pledge and how to optimize your borrowing power. Now that you know how securities are graded, let's see how those grades affect the interest rates on your margin loan. Grade A securities are of better fundamentals, so they qualify for the lowest interest rates. Grade B securities are a bit riskier, so their rates are slightly higher. But what happens if your portfolio has both Grade A and Grade B securities? Your overall interest rate is calculated based on the amount of your loan that's backed by each grade, starting with Grade A and then Grade B. Let's break it down with an example. Suppose you have $10,000 in Grade A securities and $5,000 in Grade B securities. At 100% valuation, your maximum marginable loan is $8,000 for Grade A, which is $10,000 divided by 125%, and $4,000 for Grade B, which is $5,000 divided by 125%. Now, say you want a $5,000 margin loan. Since your Grade A securities alone can cover this amount, you get the lowest interest rate, 3-month SORA plus 1.25% per annum, or about 3.85%. That means you'd pay just $192.50 a year in interest, which is 3.85% times $5,000. Keep in mind that the 3-month SORA rate changes daily. Compare this to a traditional flat rate scheme at 6.6% interest, where you pay $330 a year, which is 6.6% times $5,000. With grade-based margin financing, you save $137.50 a year on interest. It's a smarter, more cost-effective way to finance your trades and keep more of your returns in your pocket. Let's recap why grade-based margin financing, GBMF, is worth considering now that you know how security grades affect your interest rates. Lower interest costs. With GBMF, you can cut your financing expenses by using high-quality securities as collateral. This is a big advantage over traditional flat-rate schemes where you pay more regardless of the assets you pledge. Flexible portfolio management. GBMF lets you mix and match different grades of securities to optimize your borrowing costs. For example, you could deposit lower-grade securities to buy higher-grade ones. Since higher-grade securities come with lower default risk and lower interest rates, you can build a more stronger and more cost-effective investment portfolio. Transparent interest rates. With CGSI, you always know where you stand. Our floating rates are linked to publicly available reference rates, so you get full transparency and fairness. Curious about the grades of your shares? Just click the link in the bio to check the latest grades for all marginable securities. It's fast, simple, and keeps you in the know. Grade-based margin financing gives you more control, better rates, and the confidence to manage your investment smarter. In our next episode, we'll explore how collateral values are derived in your margin trading account and how does collateral value affect margin ratios. Stay tuned.